Assalamu alaikum. This is lecture 38 of Advanced Cost and Management Accounting. We have been discussing the topic of economic order quantities, and we talked about the quantitative model as a technique for control of inventory. We have seen that inventory cost is an important cost, and there is a technique and there is a need to try to minimize this cost and to try to make it more efficient. We have used the EOQ model to try to find out the point at which the total cost is going to be minimum for holding and ordering stock. We are going to now extend this discussion and take it into the production process. We are going to see that when you are producing, then whether in each production run, the quantity that you use and the amount that you use to produce for each run, can that be looked at in the same way where cost can be minimized? Are there any similarities between holding cost and ordering cost and the production setup cost and the ordering costs, as well as the holding cost? Now, the production setup cost is a combination of the stoppage of the machine. It is a combination of the machine downtime plus any materials required for the setup of the machine, the cleaning of the machine, the drainage of the pipelines where there are, if it's appropriate, and all other aspects which are set up so that you can make a production run. And a production run means one production process. You put in the material and you start the machines and you take the output. So this is one production run. Now, what should be the size of each production run? And we have said that the quantity of inventory matters. The holding cost is going to matter. The size of the run is going to determine the size of the inventory. How much product is going to become available after the production run, and that has to be stored and kept in inventory. So the size of the inventory will be dependent on the size of the production run. For example, if you produce in batches, one batch is 5,000. At the end of the batch, you will be expected to receive an output of 5,000 units. Similarly, you could be producing a batch of 30,000 units. So at the end of that production run, you are expected to receive 30,000 units. So the size of inventory is going to matter according to the size of the production run or the production lot. Now, how to optimize? This is our objective, once again, to optimize the quantity of the production run so that we minimize the cost. Optimum lot size of a production run. The EOQ formula can be adapted to determine the optimum length of the production run when setup cost is incurred only once for each production run. Setting up the process, setting up the machines, setting up a production, this is cost. Usually it is required only once for each production run. The exception would be if there was some kind of a breakdown, and that breakdown can occur due to machine error, due to handling error, operator error, or it can occur due to material quality, etc. So there are various reasons for which the production run can be stopped and has to be restarted. But normally you expect, in the absence of such errors, that the production run will run smoothly from start to finish, and therefore the setup cost is going to be required once for each run. In the cases of our breakdowns, you might need to set up once again. So the setup cost might be, for one run, you might have more than one setup cost. Of course, this is, it has to be classified as wastage. It has to be classified as excessive cost, extra cost incurred, creating additional burden and additional cost, to be minimized and to be kept to the minimum. So in the absence of this breakages, we are saying that perhaps the setup cost will be incurred once for each run. Now, in that scenario, we can use the economic order quantity model to also arrive at the most efficient size of the production run. Setup costs include labor, material, machine downtime, and other related costs. These are the costs which form part of the setup. Normally, in a process, the machines have to be made ready in terms of either their cleaning, their servicing, the operator has to be there, in terms of their operating capacity and their maintenance, etc., that the machine is going to run smoothly throughout the time it is under process and it is producing goods. Material, of course, is going to be used as a start. Sometimes it's called base stock, the stock that you first need to start with. So you fill the machines with the base stock, the amount of stock that it needs to continue and carry on the production run. So material it is going to require, it is going to require labor, it is going to require machine downtime. Naturally, at the time when it is being set up, it is not being used. So that time and that cost is regarded as cost of setup when the machines are shut and they need to be prepared for the process. Other related costs, as I said to you, if there are different kind of pipings involved, there might be some cleaning cost involved. We might need to oil and grease the machinery, so there is lubrication, etc. involved. So these are other different kind of indirect material, and there is, of course, indirect labor cost involved in trying to set up the machine. So these are the different setup costs of the machine, and that is the cost that we are going to consider, which needs to be minimized together with the holding cost. Optimum number of units to be manufactured in each run involves balancing setup costs with holding costs to arrive at the optimum size of the production run. And don't forget that the optimum size of the production run can also be a factor to determine the number of production runs. The greater the size of your production batch, the fewer will be the batches that you will run. And therefore, the number of production runs will also be affected by the size of each run, given that we will be dealing with a fixed quantity of production planned or required for 1 year. So similar to our EOQ for the holding and ordering costs, we can use that model to identify the size of the run and try to minimize the cost of setup and the cost of holding. Holding cost will depend on size of inventory, which also again will depend on the size of the production run. So we are going to use the same model, and we are going to insert, instead of the ordering cost, we are going to insert the setup cost. And we are going to assume that setup cost is once for every production run. To apply EOQ formula, simply substitute setup costs for ordering costs. The formula for the economic order quantity will work the same for setup as it does for ordering. So in the formula, in the place of ordering cost, we are going to substitute the setup cost. Ordering cost per order we called O. Setup cost per production run we are going to call S. So when we substitute in the formula O for S, we will get the most economic size for each production run. Optimum lot size for a production run. Lot size is once again the size of the batch or the size of the production run. So a lot size means that what should be the quantity of units for each batch or each run. We were given that in the EOQ model, Q is equal to under root 2 DO over H. We said we are going to replace ordering cost O by setup cost S. So we can say that Q is equal to 2 ds over h, all under root. Two functions therefore can be achieved by using this formula: the function of the ordering quantity and the function of the setup and the lot size or the production run quantity, which is the batch size. They are both similar in nature anyhow. The ordering is also done in a way in batches, and you have an order size, and the production is done in batches and you have a batch size. So simply by using the cost, of course the costs are going to be different. We have just discussed that cost in setup is the cost of the labor, the material, the machine downtime, the other indirect material and labor cost. So these are the costs that are going to be estimated, and as was the case with ordering cost, you can have on average basis a cost per setup, and that can be arrived at by looking at the entire setup costs for the whole year and the number of setups that were done. So you can arrive at an average setup cost per setup for estimation purposes. So we are going to use S as the average setup cost per setup. You substitute the S instead of the O in the formula, and that will give you the economic setup size or economic lot size. Assume annual demand D for a product is 9,000 units. Labor and other expenses for production run requires setup cost of rupees 90. Holding cost is rupees 2 per unit per year. The EOQ model can be used to determine how many units should be scheduled for each run. We are going to again use the data or information given in this example for the computation of the run size, batch size. 9,000 is the annual requirement, 90 rupees is the cost per setup, and 2 rupees is the holding cost. Inserting these figures into the formula, we can get to the best, most economical batch size. Using these figures and inserting them into our formula, we can get that Q is equal to 2 into 9,000, the demand D, and 90, the setup cost S, over 2, which is the holding cost, all under root. All of this is under root, and this gives the answer of 900. So this implies that 900 would be the most economical batch size for the example we have just seen. The calculation is the same. We insert into the formula the numbers that are given. So in this example, 9,000 was the total requirement for the year, 9,000 for D. Setup, we are told, is per setup the cost is rupees 90. So 9,000 and 90, 2 over divided by H, and we were told the holding cost is rupees 2 per unit per year. So H is 2, and insert this information into the formula, and the answer we get is 900. So 900 turns out to be the most economical batch size. This implies that if you have 9,000 requirement for the full year and you use 900 as a batch size, then you will need 10 batches in the year. So this is one way of estimating how many batches you will need in the year, and you can time and pace the batches, how and when to time and when to complete the batches. Optimum lot size for a production run with a demand of 9,000 and production run of 900 units per run, there will be 10 production runs. If working days are 300 each year, there should be a production run every 30 days. This kind of useful information can be obtained by taking estimates for the batch size. Total requirement is 9,000. We arrive at the most economical batch size of 900. So we know that 10 batches are required in a year. And taking information from the example, if there are 300 working days in a year, on average, other than holidays and leave, etc. So if we take 300 working days in a year, then in those working days, you need an average of 30 a batch every 30 days. So every 30 days, you produce one batch, and 10 batches will be produced in 300 days, and that's the requirement for the year. So this is the kind of information that becomes available, which is useful in planning, and it's useful in running the organization and when to run the batches. And the most economical size means that is going to reduce your cost and keep the total of the holding and setup cost together. It is going to keep them at a minimum. If the number of setups or the number of runs, production runs, which is the same thing, or batches, there are different ways of saying the same thing. If this number is going to increase, then the setup cost required for each run is going to increase. But the greater the number of setups, the smaller will be each batch size, and therefore the requirement to hold inventory will be lesser, and so holding cost will be decreased or reduced with a greater number of batches. So it's again the same sort of balancing required here between the number of batches and the size of the batch. So the formula is going to give an estimate of the size of the batch, which can also determine therefore the number of batches required to be produced in a year. If demand is 9,000, then 30 units are required each day divided by 300 days. And if setup takes 3 days, production run should be started when the stock level reaches 90 units. We will take our example then one step further and say that once we have the information of how many batches we need in the year, we can also then say at what point should the new batch be started. And in our example, we are saying that assuming setup requires 3 days, and we know that the annual consumption per day is 30, because in 30 days we need 900, so every day we need 30. So in 3 days we are going to need 90 units. Now if setup takes 3 days, that means when the stock level falls to 90, that's the time to start the next batch, because the batch setup is going to take 3 days, and we have inventory of 3 days in hand, which is 90. So it also in a way tells you when to start the next batch, how many batches to have in a year, and therefore it is like a planning tool and a planning exercise to time the batches and the size of the batches to provide the minimum total cost. Quantity discounts. Where firms are able to obtain quantity discounts for large purchase orders, the price per unit will differ, and this must be taken into account in the EOQ. We referred to discounts earlier, that if you obtain a quantity discount on your large size of order, then the price is going to come down just because of the order size. Quantity discounts are very often seen in markets and stores where they put up signs of special discounts and special sales and seasonal sales and so much off, and all these are discounts which affect price. Sometimes you get buy one and get one free. This is also a buy two and get one free. This is also like a quantity discount. So where the order size increases and you then become entitled to a discount, then that discount is additional saving. And because this affects the cost, then this saving should be taken into account in the EOQ calculation, in the order quantity calculation, in the costs. We have looked at the ordering and the holding costs, and we have tried to minimize these two. But in our holding cost, we have included opportunity cost of investment. At the same time, we need to examine the saving that is available from the quantity discounts if we increase the size of our order. So how should we take this into account? We'll look at that in the example. The differences will arise as follows: saving in purchase price, reduction in ordering cost, increase in holding cost from high stock levels. If we are going to increase the size of our order, then what will be the difference that will arise because of the discount? One, there will be a saving in the purchase price. So the cost of purchase is going to go down. Secondly, there will be a reduction in ordering cost. Why a reduction in ordering cost? As we have increased the size of our order, we are going to reduce the number of orders. In order to avail the quantity discount, the size of the order will be increased. So as we increase the size of the order, the total number of orders will be reduced, and therefore the ordering cost is going to reduce. But again, as we have discussed, when we increase the size of the order, the holding cost is going to increase because the average inventory held is going to increase. So these are the three different impacts that we are going to see with this quantity discount: saving in price, reduction in ordering cost, increase in holding cost. Example of discounts: a company purchases raw materials at a cost of ₹7 per unit. The total annual demand for the product is 9,000 units. The holding cost is ₹4 per unit and ordering cost is ₹5 per order. A quantity discount of 3% of purchase price is available for orders in excess of 1,000. Should the company order in batches of 1,000 units and take advantage of quantity discounts? So let's look at an example how discount is going to affect the calculation of the EOQ, the order quantity. We have said that once a discount is on offer, it is going to have impact on the EOQ, and we identified the three different ways in which it has an impact. Now we are given an example where 9,000 are the units required in 1 year. The cost of unit is 7, and there is a holding cost and an ordering cost. Holding cost is ₹4 and ordering cost is ₹5. We are given the information that there is a possibility of 3% discount on the purchase price if the quantity ordered is 1,000. Now, in trying to arrive at a proper decision based on the cost comparison, whether the company should avail this discount offer and possibly increase the size of its order, and whether what would be the most economical order size otherwise, and what would be the costs that would be incurred in that case. So the EOQ is going to give us the minimum cost, the order that gives the minimum cost. Now, in arriving at whether a discount should be availed or not, the procedure to follow is to first of all calculate the EOQ as we normally do. Without the discount, we should first calculate what would be our EOQ, in other words, the least cost order size. So we calculate the order size based on our formula, and then we compare that with the savings and the additional costs that would be incurred. Assuming the information given in the question, we can apply the formula, use this information, insert the amounts into the formula, and arrive at the EOQ. Should the company order in batches of 1,000 units and take advantage of the quantity discounts? the starting point is to calculate the EOQ and then decide whether the benefits exceed the cost. Using our formula and the information given in the question, the EOQ will be given by the under root of 2 multiplied by 9,000, which is our D, multiplied by 5, which is our O, and divided by 4, which is our H. So 2DO over H all under root, and the answer we get is 150 units. So in all these cases where we are given discounts, the first step is to calculate the economic order quantity without regard to the discount. So we were given the order size and we were given the total annual demand of 9,000. Then we were given that the ordering cost is 5 per unit per order and the holding cost is 4 per unit. So using this information, we are going to insert the information in the formula and arrive at our economic order quantity. This quantity is 150 units. So 150 units is the quantity of the EOQ. The basis, first of all, is to arrive at this EOQ, and secondly, then we can look at the difference it will make to avail the discount. Savings made if purchase is in batches of 1,000 instead of 150 units. Price 3% multiplied by 63,000 will be the cost in the full year, and that gives 1,890 as a price saving. Ordering cost, the ordering cost is going to be 9,000 divided by 1,000. So the number of orders in this case would be 9 multiplied by 5 minus 9,000 divided by 150, which is the EOQ. That gives the required number of orders multiplied by 5. And the difference between the ordering cost for the two order sizes would be 255. That would be the ordering cost saved because there will be lesser number of orders made. Holding cost, we said, is going to increase. So the saving is the 1890 and the 255. The increase in holding cost is going to be the order size of 1,000 minus 150 divided by 2 to give what will be the average increase in stock held, and the holding cost multiplied by the holding cost of rupees 4 per unit, and this gives 1,700. So we can clearly see that the additional cost is 1,700, but the saving is 1890 plus 255. So of course the saving is greater than the additional cost. So that's how we are going to arrive at the decision on whether or not we take advantage of our quantity discounts. And just to recap, we are going to calculate the EOQ as we always do using the formula 2DO over H all under root. Once we get to the EOQ, in our case, in this example, it was 150. So EOQ gave an order size of 150. The discount was available for order sizes of 1,000 and above. So 3% discount was available. So the three factors that affect discounting was, one, the saving in the purchase price, and the way we calculated the saving in the purchase price was to take the 9,000 units at price of 7,000, which gives the total annual cost of 63,000. And we can save 3% of that, and that came to 1890. So the saving in the purchase price and the saving in the ordering cost. Ordering cost because there will be fewer number of orders. The cost per order was rupees 5. The order size will reduce from 9,000 divided by 1,000, and it will from 9,000 divided by 150 to 9,000 divided by 1,000. So therefore, we can see from this that the saving in ordering cost is 255. So these are the two savings, 1890 and 255. The increase in holding cost is going to result from the additional average inventory. And the average inventory will be, that increase in the inventory will be 1000 minus 150 over 2. So 1000 minus 150 over 2, this is the average inventory held, the difference or the additional average inventory. And multiply that by the holding cost of rupees 4, you get 1700. So the additional cost is 1700 and the savings are 1890 and 250. The savings are greater. This is the way in which we can compare the benefit of the quantity discount. Of course, where we find that the holding cost increase does not justify the additional savings from the quantity discount, then that quantity discount should not be availed. That should be ignored. So basically, on a cost benefit basis, we have to arrive at our decision. But the mechanism is once again that you calculate your normal EOQ and then you compare the savings and the additional cost. This has given us the basis to arrive at our decision of whether we should accept the purchase discount and increase our order size. This is a convenient way and a calculated and a mechanism, and it gives us a proper basis to form our opinion and form our judgment, because not always will a price discount due to increase in order size be justifiable. Not always will that be of greater benefit to the company, where the discount is such that it does not benefit at least as much as or more than the additional cost. That discount the company will not avail. The reorder point. To determine the reorder point, we must ascertain the lead time. This is the time taken between placing the order and delivery of stocks. Again, try to understand what we are referring to when we say the reorder point. And I want to, in fact, take you back to the example of filling petrol in the car. The car has petrol, it is running, and as it's running, the more mileage it covers, the more petrol is consumed, and the indicator needle shows what is the level of petrol that is still available in the car. So now the user has to keep some kind of a target in his mind that when the petrol in the car is going to reach a certain level, then he's going to refuel. This refueling is in a way like reordering. So when vehicles are being used and you are using on a daily basis and driving around and consuming petrol, it is going to fall to a certain level. Usually you would like to think that it should not fall below a level that once it reaches, then you have to reach the nearest petrol station. So you should be able to reach the nearest petrol station. There should be enough fuel in the car to reach the nearest petrol station before you run out of fuel. So refueling must be done at least at the point where there is fuel sufficient to reach the next fuel station. But there are other different parameters that can be kept in mind. So this is a concept, in fact, of reordering, that you are now setting yourself a level at which you will reorder and start to acquire more inventory. So the example, and I think the same example can be applied just to understand to the use of cash, how much cash you should carry on hand. Every time you go to the bank, you withdraw out cash, and then you start to use it, consume it, and the balance of cash goes down. But before it reaches zero, you would like to go and visit again and draw more cash. So that's like a reorder point in a way. That's how reordering is done, that you have inventory, you're consuming inventory, the balance goes down, and at a certain point, you want to reorder and fill your stock and come back to a level of stock where you start consuming once again. So this is the point of reorder point. Now, when we are dealing with stock, then we are going to deal with lead times. Lead time means that from the time you place the order and the time it takes for the stocks to arrive. This is lead time. So why is it important? This lead time is important because this is the time where you will not have stocks, but you will have ordered. So you must have sufficient stock to cover the lead time. In other words, if you did not have stocks to cover the lead time, then you may place an order and the inventory is going to arrive, but before it arrives, you run out of stock and you cannot produce. So that is a situation which companies will try to avoid, and they will work their reordering in such a way that the stocks arrive before their existing stock levels run out and finish. This is the concept of lead time. Lead time, therefore, will be a guide as to how much stock should be in store before you reorder. The reorder point will be the number of days in lead time multiplied by the daily usage during that period. So the reorder point, if calculated in the number of units, that will represent the usage and the number of days it takes for the stock to arrive. In other words, the number of days in lead time. So number of days in lead time multiplied by average usage, daily usage, this is going to give you the reorder point. This is on a normal condition basis and without any margins for errors, without any margins for other events that will change the usage of stock. So assuming that stock consumption is constant and we take the number of days in lead time, multiply that by the usage, you can get at the reorder point. For the manufacturer, the reorder point is the level of finished goods stock at which production orders should be issued. There will be a difference between, let's say, a manufacturer and a trading environment. The manufacturer, we are saying, is interested in producing his goods and manufacturing them and selling them. So for him, the reorder will be the point at which the production order should be issued. In other words, he has to start the next run. So the reorder, his reordering is basically in terms of the production run. When should he start the next production? So production order represents for him the reorder point. And that's again going to be calculated by reference to the lead times and the inventory in stock and the daily usage and consumption and so forth. For materials and components, it is the time when the purchase requisition is initiated. When we are dealing with materials and components, these are items stored in inventory and they need to be ordered. A purchase order is usually initiated. So there is usually a reorder point marked for each item of inventory, indicating what is the usage in the lead time. And for them, the reorder point will be the point at which the purchase order will be initiated. A requisition is made, a requisition is sent to the purchasing department. The purchasing department looks for the best quotations, and then they place the order and goods arrive. So that process has to start, and where that process starts, that's the reorder point, where the requisition should be raised. Requisition is the document from the storekeeper that goes to the purchase department, informing the purchase department that the items in inventory for this particular item have fallen to the point where they need to be purchased again. So that is, the note is the requisition note, called a requisition note, like a request to place the order. And the purchasing, of course, is done by the purchasing department. Example of reorder point. Assume annual usage of raw material is 6,000 units and weekly usage is constant. In 50 working weeks in a year, the weekly usage will be 120. In other words, 6,000 divided by 50, the weekly usage will be 120. If the lead time is 2 weeks, order should be placed when stocks fall to 240 units. EOQ can indicate how frequently the stock should be purchased. One other use of EOQ is to establish the reorder point. This example shows that there is annual usage of 6,000 over a working year of 50 weeks. So average per week usage is 120. Now, if we are saying that the lead time is 2 weeks, then when should be the next order placed? The next order should be placed when the stocks fall to 240, which is the usage for 2 weeks. So in other words, 2 weeks, when 2 weeks stock is in hand, the reorder point and the reorder processing should be started. And this is now giving you, in a way, planning for stocks and materials and setting out reorder points to help you in the materials control and material inventory control and planning. So the EOQ, therefore, is going to indicate how frequently the stock should be purchased. Once you have the quantity, which is the EOQ, you know how many times you are going to purchase in a year, and you take your lead time, and you with the requirement for the lead time to be held in stock, that's the time when you are going to reorder. So EOQ is another, not only showing you how to minimize the holding and ordering costs, but also how to control inventory in terms of reorder points. If EOQ equals 600 and annual demand is 6,000, 10 orders will be placed every 5 weeks. Taking our total of 50 weeks, where you have annual demand of 6,000 and EOQ shows 600, that means 10 orders are going to be placed. If 10 orders are placed, that means that there will be over 50 weeks, every 5 weeks, you place an order. However, with a lead time of 2 weeks, the firm will place an order 3 weeks after the first delivery, when the stocks will have fallen to 240 units. 600 units EOQ less 3 weeks usage at 120 units per week. The order will then be repeated with 5 weekly intervals. The working shows that you can then work out if you have to place an order every 5 weeks, but it shows you that the lead time is 2 weeks, then you can time the order after the first order, and that means that the first order will be made, and then 3 weeks later the second order will be made to allow the 2 weeks lead time, and thereafter the rotation will go on after every 5 weeks. So this is the planning of how to order, and in order to ensure the EOQs, and secondly the timing of the ordering, the reorder point. The EOQ model can therefore be used to indicate when to replenish stock and the amount to replenish. Giving you the benefit of EOQ, we said earlier on that there are several assumptions and that the calculation might just be an estimate, and there are practical points which will make the EOQ for any particular organization a little inaccurate, because we are assuming constant usage throughout. We are assuming that the fixed cost will remain fixed and the variable cost will remain variable. All these things are subject to change, and the EOQ that we finally end up with is like an approximation. But here we are seeing that once you have that estimate in mind, then there are several other uses that that can be drawn from this EOQ. That not only is the cost perspective covered and minimized, but the reordering and the reorder point and the timing and the lead times, etc., all those things can be figured in the overall planning of inventory control. Safety stocks. Safety stocks are the amount of stocks that are carried in excess of the expected use during the lead time. Safety stock can be compared in our environment currently almost to the checkpoints in the traffic. That once you are traveling on the road, there are at different intersections and different points, there is a check post where traffic is being checked, and where if there is any suspicion, then the driver is asked to pull to one side and the car is examined, the driver's documents examined, and so forth. This is now trying to make sure that there is no danger that lies ahead, to overcome some kind of danger. Now in stocks, the security stock is trying to cover the danger of running out of stock. So we need to have what is called a margin of safety or a safety stock. Now how does that build and how does that hold for the EOQ? Let's see. This provides a cushion against running out of stocks because of fluctuations in demand. We have set the limitation, and the assumption of EOQ is that the usage is constant, the demand is constant, but that of course might not be true. So there might be fluctuations, and in order to safeguard that due to increase of fluctuations, the company does not run out of stock, there is a margin of safety that is held. For example, lead time equals 2 weeks, weekly usage is 120 units, reorder point will be 240 units. However, if weekly usage increases to 140 units during lead time, or lead time goes up to 3 weeks, the firm will fall short of stock. These are the kind of examples and situations that we discussed that they are going to impact on your EOQ and on the firm's ability to continue and not run out of stock. So if there is a variation that we have assumed 120 units per week and that increases to 140, or we are assuming 2 weeks of lead time, sometimes because of supplier problems that can extend to 3 weeks, then in that case there should be a margin of safety to cover for these kind of variations. The response of a firm may be to reorder at 420 units to allow 140 usage for 3 weeks. This will consist of reorder point based on normal usage and lead time of 240 plus 180 units of safety stock. This covers the possibility that lead time and expected usage will be greater than projected. So one example of safety stock will be that you are going to use for your lead time. If you have lead time of 2 weeks, you can assume that there could be a lead time of 3 weeks. You can assume that the consumption can increase to 140. So normal reorder point will be calculated as it is, but a safety stock will be held just in case the lead time increases or the usage increases. So this is basically the use of safety stock, and that is going to be held in addition to your normal reorder point. Calculate the normal reorder point and have a margin of safety. Of course, the margin of safety should not be too large because that is going to add to the costs. That's all for this session. Thank you for listening.